Good evening, ladies and gentlemen. It's Matt Bowles here, Maverick Investor Group. I want to welcome everybody to a very exciting webinar event this evening, how to use your IRA or 401k to buy investment properties. Let me just take a quick poll of folks here. I want to make sure that we get started on time, first of all, and I'm going to go through a couple of housekeeping items. We're going to do a kind of a check-in with folks that are on the webinar, and then we're going to get to some really substantive content for you tonight. We've got a fantastic guest expert here. So just housekeeping to begin with. You have on your screen there a chat box, and that chat box allows you to communicate with us during the webinar. We might ask you some questions, check in with you on some stuff, and you can type your answers in the chat box. It's also going to allow you to participate in our Q&A, which we're going to do at the end of the webinar. So we're going to go for probably about 45 minutes or so with the content, and then we're going to have a Q&A period. We're going to open the floor for you to have access to our guest expert. So that's going to be the structure for the evening. Let me start off by asking, first of all, a question, and we'll just check and make sure the chat box is working. How many people here have a self-directed retirement account of any kind? A self-directed IRA, a Roth, self-directed Roth IRA, solo 401k, anything. If it's a self-directed retirement account, just type into the chat box. Just type, the word yes or something like that to let me know if you do. And if you don't, just go ahead and type the word no and let me know about that as well. So just type into the chat box whether or not you have a self-directed retirement plan currently. Okay, cool. So we've got people that do, and we've got a lot of people that don't, and that's awesome because what we're going to do tonight with the content is we're going to include some basic stuff for beginners. If this is your first exposure to the concept of a self-directed retirement plan, you're looking to maybe start one or see if it's right for you. We're going to definitely cover the basics. We're also going to go a little more in depth. Do some pretty cool, cover some pretty cool, more advanced stuff, and be able to answer any more of the advanced questions that you may have. For example, if you already have a plan, you've been working with one, and so forth. So we've got something for everybody here tonight. Awesome. So we got a lot of people saying yes, they have a certain type of plan, and a lot of people saying no. So great. Awesome mix. We've developed the content as what we anticipated. So we're developing the content for that. I'll just start off too by welcoming everybody here. I know and recognize a number of people that are on the webinar, but we also invited and allowed the agents in our community, the real estate agents in our community, to invite their own clients to the webinar. So I know there's a number of people here that may not be that familiar with Maverick Investor Group, with what we do and so forth. So I'll just take about a minute and just sort of give you that overview and how that relates to what we're doing tonight. So my name is Matt Bowles. I'm one of the founders of Maverick. We've been around since 2007, helping individual real estate investors buy rental properties in different real estate markets around the country, to buy and hold performing rental properties in different areas, build diversified portfolios over time. We've been featured in a lot of the real estate press. If you do know Maverick and you have been following us, been investing in real estate with Maverick and so forth, you know that a lot of what we emphasize is about the virtues of real estate is being able to control your own investments, being able to buy and own hard assets, and not having to surrender your hard-earned money, your investment dollars, your retirement money, your kids' college money, not having to surrender that to the whims of the stock market or some broker that may or may not know what he's doing, and your money may or may not disappear overnight in a stock market scandal and that kind of stuff. One of the things about real estate is that it empowers you to have more control over your investing, to invest in hard assets that you own, that you control, that produce income for you, and so on and so forth. So with the webinar tonight, what we want to do is take that to yet another level, okay, and make sure that you understand that just like with the reason you'd buy rental property normally, as opposed to just putting all your money into mutual funds, the same is available to you through self-directed retirement plans. A lot of people think or feel or have historically been encouraged that all of their money inside their retirement plan should go into these mutual funds and all this other kind of stuff. And so what we want to do tonight is really break that down and show you that in fact for years, back till I think it's 1974, the very wealthy have known about and have had access to legally being able to use self-directed retirement plans where they don't have to just put their money into a handful of different mutual funds and pick from a few different choices like that. Instead, they're able to take total control of their retirement money, just like their regular money, and buy hard assets like deeded freehold real estate that produces income. Now, I'm not talking about a REIT, a real estate investment trust. I'm not talking about deeded, I'm not talking about securitized real estate-backed securities. I'm talking about deeded freehold properties, just like they would with their regular money, okay? And it's been a very exclusive domain. I think still less than 5% of all retirement plans are self-directed, so it's a very exclusive domain, but as long as you do it properly, okay, and you work with a custodian, an administrator, and a company that knows what they're doing, it's completely legal, and we're going to go through all that tonight, how you can potentially have access to this evening. And that's one of the things that that we also as Maverick like to do is we want to be able to, in addition to providing you access to investment real estate and sharing with you information about which markets are the most advantageous for investors and which markets as they change over time become more advantageous and how to diversify your portfolio and build your wealth through real estate. In addition to all of that, we like to introduce you to other industry experts, okay, and to allow you to access, what we sort of call our golden Rolodex, okay. We've been in the industry a long time. We know a lot of the top people and the top experts in the industry who can add value to your real estate investing by providing auxiliary services of various kinds, to support you and add value. And so that's really what we're doing here tonight is we're going to introduce you to one of the nation's top experts on self-directed retirement investing, okay? And we're going to introduce you to the company where I personally have my self-directed retirement account. The custodian and the administrator of my self-directed retirement account is who you're going to meet tonight, okay? And as a result of that business relationship, both on a personal level and on a business level, he's agreed to come here this evening to spend the evening with you and to share some really valuable content and to answer your questions. So without further ado, I'd like you to meet a senior account executive at the Equity Trust Company, Mike Kozart. Mike, thanks so much for being here.
Thanks for having me, Matt. I'm glad to be here.
Fantastic. So I will turn this over to you. We may dialogue a little bit throughout the webinar here. I'll jump in and we can chat about some stuff. And I'm pretty much just going to let you, run the show. You've got fantastic content. You are one of the smartest guys that I know on this subject matter. So I'm just going to let you take the floor.
Well, thanks for that introduction there. I definitely hope I do it justice. And I can say up front, everybody, obviously, as you see the disclaimer slide in front of you that I'm required to show, always like to start off and just let you know that Equity Trust, we do not give any legal or tax advice. We cannot recommend or endorse any investment, so you're doing your own due diligence. And we always encourage you to seek professional legal or tax advice when it comes to doing these investments. So, but Matt, again, I want to say thanks for having us tonight. We've been doing this a while. Equity Trust is the oldest and largest self-directed IRA custodian. Our founder, Mr. Dick Desich, actually performed the country's first real estate IRA transaction back in the early 80s. And news of the investment spread, and long story short, here we are today with the self-directed IRA industry. Equity Trust, as of the end of 2013, serviced over 130,000 clients. As you see the stats on the screen, majority of what we do is in the real estate world. So majority of our clients are doing some sort of real estate deals. Obviously, there are a number of different strategies in that world, but we know what we're doing with this. Real estate is our bread and butter. We actually have a business called Equity University, whose sole purpose is to educate investors and those who are looking to invest on self-directed IRAs So we're always going around the country, and actually that's how I was fortunate to meet Matt. We're always going around and spreading the news, helping folks learn how to do this because it really is a powerful tool. We definitely these days have a focus on customer service. You don't get to be the biggest and best at what you do without any growing pains, which obviously we've had ours, but definitely we have a focus on customer service. So I'd be happy to help anyone out who has some interest moving forward. So what we're going to cover today, we're going to cover a lot, so I encourage you to take notes. At the end, we're going to allow some time for questions, so definitely write those down, take some notes as you go, as we'll cover a lot of content. Really, we're going to cover the different types of tax-exempt accounts. There are 7 that you can utilize to do this. Everyone can and potentially should have multiple accounts to really maximize your tax advantages here. We're going to cover different types of investment options with a focus on real estate, but covering how that happens, the different financing options, how you could do these investments, as well as how to create your own private bank of IRA investors and generate more funds to do more deals. And then obviously we'll walk you through the process of getting started with your own self-directed IRA, as well as directing those investments. So really the major concept, why do you want to do this with a self-directed IRA as opposed to just using cash out of pocket? And the simple answer is compound interest. IRAs are not subject to tax on ordinary income tax, capital gains, rental income. All of those sources of income are actually exempt within an IRA environment. So you're keeping 100% of your profits, and you're able to reinvest those. Einstein said that the most powerful force in the universe is compound interest. The slide you have in front of you here, really what this is illustrating is that power. If you were to have $50,000 and invested it over the course of 20 years, getting about a 10% return, if you're doing that inside a tax-advantaged IRA, at the end of the 20 years, assuming the tax rate's there, you'll have about $336K. In that account, as opposed to having taxable, doing things outside of the IRA and paying taxes on your investment earnings potentially as you go, you could be looking at 195K. So that's generally the concept there. Now the 7 different account types that you could do this with are on the screen, but I think it's important to first understand what is a self-directed IRA. I have folks come to me all the time who will say something like, I have a self-directed IRA with Fidelity. Well, Fidelity doesn't do those. A lot of people think that they have a self-directed IRA if they can choose their own investments. And if we're speaking about the English language, you are correct. But a self-directed IRA really means that your custodian, like Equity Trust, allows you to invest in investment options and asset classes outside of the traditional stock market. So usually the IRAs that many folks have today, the 401ks you have, you're invested in stocks, bonds, mutual funds, and you're pretty much limited to those selections. A self-directed IRA, you can do things like real estate and own real estate inside that IRA. As you see, most of the retirement accounts that you'll see, most of the IRAs that you'll see are traditional or Roth IRAs. These are the most common. The self-directed traditional and Roth IRAs that we have here at Equity Trust and as well as at other custodians are no different than the traditional or Roth IRAs that you could have at a Fidelity or Schwab or whoever. We all follow the same tax guidelines, the same IRS guidelines for contributions. It's just that we allow you to have more investment choices. So you see those are the more common ones. If you're self-employed, you have a few options as well, which potentially have some higher contribution limits. And then there are some alternative accounts that aren't retirement accounts. You could actually pay for a child's education using doing real estate investing and potentially pay for a child's education tax-free, as well as a health savings account where you could save and do these sort of investments inside that tax shelter as well. So there's a number of different options. The first one is probably the most common, which would be the traditional IRA. Most people are familiar with this. If you have an IRA today and you don't know what kind it is, more likely than not, it is a traditional IRA, and that's because most of the retirement funds in the country are pension funds, 401ks, 403bs, etc., and those are generally speaking tax deferred contributions. And when you leave that employer, generally speaking, you will roll that over into a rollover or traditional IRA. And really, what that means is it's a tax-deferred environment, and the money that you put in, you received an income tax credit for those contributions. So you've not yet paid tax on that money. You're going to make successful investments ideally, and then when you go to retire and pull those funds out to utilize to support yourself, you will then pay taxes at that time upon distribution. As you see, annual contribution limits are $5,500 and $6,500 based on your age. It ties into a Roth IRA. So Roth IRA is pretty much the exact opposite of a traditional IRA. Some would consider it tax-free. Basically, this means that you did not receive that tax credit for the funds that you put into the account. And because you've already paid taxes on that money, it's basically sitting in your savings account after your taxes were taken out of your paycheck. You are not going to be taxed again on that money. So when you take it out in retirement, it is tax-free. Very powerful tool, very powerful concept to understand is the concept of tax-free growth, especially as we talk about compounding interest. As you see there, and a lot of you are probably aware of this, there are limits to who can contribute directly to a Roth IRA. As you see, if your modified adjusted gross income exceeds 131K, if you're a single individual, or if you're married, if it exceeds 193K, this is for tax year 2015, you cannot contribute directly to a Roth IRA. But the good news is, it is possible to contribute to a traditional or a SEP IRA and then convert that into a Roth IRA. So let's take a look at what a conversion means, right? So a conversion, you do not have any income limits on the conversion. Sorry, my slide is not moving over here. So as you look at how you're funding your Roth IRA, again, you can fund with after-tax contributions. You could transfer funds from an existing Roth, or you could do this conversion. Now, as you'll see on the next slide, the conversion basically means that you're taking funds from a tax-deferred environment and moving it to the Roth IRA, which is a tax-free environment. So you have to pay taxes on that money when you do that conversion. So in this example here, as you'll see on the screen, $100,000 in your traditional IRA. If you wanted to convert all of that to $100,000 into your Roth IRA, you will then have $100,000 added to your taxable income for that year, and at a 20% effective tax rate, you owe $20,000. Most investors will actually take that $20,000 out of their savings as opposed to having it withheld out of the account. Now, if you don't want to get hit with such a big tax burden, you can do a partial conversion. Which means that you are in stages converting that account over. So in this example here, you see this person only wanted to convert $50,000, so they're only adding $50,000 to their taxable income for the year. At 20%, that's $10,000. So I think you get the concept at this point, but one of the things that you'll see here next is that if you already own real estate inside a tax-deferred environment like a traditional IRA or a solo 401k, that real estate can also be converted to a Roth IRA. You would just simply take the value of that asset, convert it. Your custodian, Equity Trust, would help you in this case, and then the value of that asset is added to your taxable income for that year, and then at that point, the investment is owned by your Roth IRA and will grow tax-free. Okay, so there's many ways to do a conversion, but it's powerful to understand that, because if your retirement funds are in a tax-deferred environment today and you want to get them to tax-free, it's important to know that you can do that.
And guys, let me just jump in here too, Mike. Thanks. I just want to re-emphasize a couple things that you said, because that, for example, right there, just that segment you just did was a lot of content, and I know that a lot of people that are seeing this for the first time, that's a lot of content to digest. So, folks, I want to mention and reiterate a couple things. Number one, that the term self-directed IRA has been expropriated by a lot of the really large financial companies that do not offer truly self-directed IRAs, and they've deployed it nonetheless in their marketing and saying, hey, we offer self-directed IRAs because we get to choose from like our 8 mutual funds, and therefore you're self-directing your money. Okay, so one of the things you can do to find out if you really, you can say, hey, can I buy a piece of deeded freehold real property? Okay, I want to go buy a single-family home, a physical single-family home, and I want to buy that and own that in my IRA. Okay, and a lot of these large financial companies, what they call a self-directed IRA, there's no way they're going to let you do that. Okay, so what we're talking about tonight is a truly self-directed IRA that's going to allow you to buy a deeded freehold real estate, and a whole bunch of other stuff. We're going to get to the list in a moment of what you can buy, but real estate is really what we're focusing on here that you're not able to buy in most of these other plans. Okay, so we went through the traditional IRA and the Roth IRA, and now, Mike, I'll turn it back over to you to get into the next level of this, which is that if you are a self-employed person, man, can you even take this way to the next level? So go ahead and tell us about that, Mike.
Absolutely, and one of the concepts, I know we covered a lot of content there. One of the concepts that I know I breezed over really quickly was the contribution limits for a traditional and Roth IRA are about $5,500 to $6,500 per year. Now, as you look at, I think my slides are jumping around here. As you look at different vehicles that you see under the small business plans, you're able to actually contribute potentially quite a bit more than that $5,500 or $6,500. So you have SEP IRAs, simple IRAs, as well as solo 401ks. We're going to focus on solo 401ks as a SEP IRA is just simply a traditional IRA with larger contribution limits. Okay, so what is a solo 401k? We're all familiar with 401ks that we may have at work, but this is something for exclusively for a self-employed individual. There's a couple components to it, but basically to qualify, you have to have active earned income from being self-employed, which means you pay taxes on income, and no employees other than yourself and or a spouse. Okay, so this account is purely for yourself and a spouse, potentially. Now, with the solo 401k, there are much higher contribution limits that you'll see coming up here. So, with a Roth IRA, Roth or traditional IRA, you're able to contribute $5,500 per year. With a solo 401k, you can contribute up to $18,000. Up to 100. That's up to 100% of your active earned income, up to $18,000, and you have your choice of making that as a after-tax Roth contribution or a pre-tax tax-deferred contribution. It's a very powerful tool to understand that because you're able to effectively, let's say you only paid yourself $18,000 in your business, you can put 100% of that in a tax-deferred or a tax-free environment. Inside this solo 401k. If you're above the age of 50, you can actually do that up to $24,000. There's no other account that will allow you to put this much away tax-free in a single tax year. There's another component as well, which as an employer, the business could also contribute up to 25% of your salary, up to $35,000 per tax year. So you could put a total of $53,000 or $59,000 in the solo 401k potentially in a given tax year. You're not going to find another retirement account that will allow you to put this much away, as well as give you that flexibility there.
And guys, the amazing thing about this is that you can put up to $18,000 into the Roth side of your of your solo 401k. And then in addition to that, you can put up to $35,000 potentially, depending on how much salary you make, into your traditional side. So, I just want to reemphasize and make sure that folks that are totally new to this, that you understand that a traditional IRA is a tax-deferred plan, meaning the money goes into it before you pay tax on that money, okay? And then it grows in there, okay? So it obviously grows faster because you haven't paid tax on it. It's going to grow faster. But then when you take it out, you got to pay tax on that money when you take it out later, okay? But a Roth means you've already paid tax on the money. So when you put it into the Roth, it can grow tax-free. It's a tax-never plan, right? So that is incredibly powerful. The problem is, and Mike, by the way, when I'm done, if I've said anything incorrect, of course, correct me. But you know, but the problem is with the Roth is that the regular Roth IRA, you've got some limitations on it. You can only contribute $5,500 or $6,500, and if you make too much money, you're not allowed to contribute at all to a Roth IRA. Okay, so with this, it removes a lot of those restrictions, allows you to contribute more, removes the high income restriction, and is just an unprecedented vehicle for folks that can qualify for this.
Yeah, absolutely, Matt. And one thing I'll add is it's always good to paint a picture that really illustrates the power of the Roth. And understanding that in retirement, when you go to pull these funds out, you're not paying taxes. So ideally, you get to the point where you're retired and you'd like to live off of your investment income. If you're doing that outside of an IRA, or you're doing it with a tax-deferred IRA, whenever you go to take money out from those investment earnings, you're paying taxes. But you actually have the ability, if you have your investments done in the Roth environment, you have the ability to potentially live tax-free in retirement. Okay, very powerful concept.
That's amazing, and I'm just going to emphasize one more point, Mike, because you went through it kind of quick earlier. I actually learned this from you, and this is really interesting, folks. If you don't qualify for a solo Roth 401k, okay, like this, you're not a business owner, you don't start a business, you don't want to go through the process to get in a position where you qualify. Mike mentioned another concept which was new to me. Okay, let's say you don't qualify for the Roth, or you know, whatever it may be because you make too much money. Mike, can you just really quickly reiterate that? I think you referred to it as a backdoor Roth concept and how that works. Let's say somebody says, "Man, this solo K looks great, but I don't qualify for it." How can they get money into a Roth if they don't qualify normally?
Yeah, absolutely. So while there are income limits on contributing to a Roth IRA, there are not income limits on converting funds to a Roth. The IRS actually lifted those restrictions, I believe, in 2010, so that it doesn't matter how much money you make, you can convert funds from a tax-deferred environment into the Roth. So in this case, you could contribute to a traditional IRA and then immediately convert that to the Roth IRA. Okay, when you contribute to a tax-deferred environment, you may get a tax deduction for the contribution, but if you convert it to the Roth, it just emits that tax deduction. You were going to pay taxes on that money anyways, so you might as well put it into the Roth. That's one way to do it. Or if you do own your own business, but maybe you don't qualify for the solo 401k for another reason, that's where the SEP IRA comes in. A SEP IRA allows you to put up to 25% of your income from being self-employed up to $53,000 tax deferred, and then you could convert that to a Roth IRA. So conceivably, you could get $53,000 into a Roth IRA in a given tax year.
That is incredible. And folks, this is why you really need to be working with an expert who specializes in this type of stuff. So I actually learned some of this stuff myself from Mike, and I've read books on this stuff. I mean, I've been around this stuff for a while, and Mike taught me, some of these techniques that they're doing with their savvier clients and stuff like that. So really, really important and high value to be working with an expert that knows how to do all this, because then based on your personal situation, you qualify for this, you don't qualify for that. Well, what can you do to achieve the financial goals that you're looking for? Let's keep rocking. Mike, go ahead.
Yeah. So just to wrap up the concept of solo 401k, this will tie in a little bit later, but obviously, as you can tell, there's a lot of benefits to it. You know, higher contribution limits, you're actually able to take a personal loan, much like a 401k that you have at work, up to 50%, up to 50K of the value of the account. And then, as we'll talk about, a concept of UDFI tax in a little bit, which is a potential tax that you could still incur. A solo 401k could potentially exempt you even further from that.
All right.
So all of these accounts, as we talk about self-directed IRAs and self-directed 401ks, it's important to understand what you can and cannot invest in. So the IRS says that there's a few things that you cannot invest in, and then the sky's the limit from there. As you see on this slide here, there's plenty of real estate types of investments that we see people making. All of these have something to do with real estate, so there's many different strategies. On the next slide, though, you'll actually see that there are things outside of the real estate realm that we do see as well. The three things that the IRS says you cannot invest into with your IRA are life insurance contracts, collectibles and alcoholic beverages. I know that sounds fun, but you can't do that. And you cannot invest into an S Corp, because an S Corp, to be an owner of an S Corp, it has to be a naturalized citizen, so on and so forth, and an IRA is not. Aside from that, the sky's the limit, right? If it's going to make your IRA money and you're following all the rules, you could potentially do it with a self-directed account. So let's just focus on real estate here. There's three ways your IRA can own and purchase real estate. The first is sole ownership. This is just a straight up 100% cash purchase. If you're buying a $50,000 piece of real estate and you have over $50,000 in that IRA, it's a cash purchase, very simple, very straightforward. The IRA owns 100% of the investment and is responsible for 100% of the expenses and will receive 100% of the benefit. The second scenario is partnering. Now, any partner is acceptable. You can partner your IRA with any individual, with any entity, any other IRA that you want. But it's important that you maintain undivided interest. Very quick scenario, $50,000 property, your IRA only has about $25,000 in it, you're putting $20,000 up to purchase that property. So your IRA is putting $20,000 down out of a $50,000 purchase. Your IRA owns 40%. The other 60% we'll just say is another investor. So your IRA is responsible for 40% of the down payment, 40% of expenses, and receives 40% of the benefit. Okay. Throughout the life of that investment, you need to keep that percentage consistent. And then the third method is financing. Okay, you actually can leverage your IRA to acquire real estate. The rules basically are that the loan needs to be a non-recourse loan, and you cannot personally guarantee that loan. So it's also further important to understand that IRAs cannot be used as collateral, which is a definite prohibited transaction to the IRS. So the only recourse that the lender really has is the property that they're securing the loan with. So because of that, you'll typically have to have a little bit more equity in the deal, but this is where also you potentially will generate what's called unrelated debt financing income and potentially be subject to a tax to your IRA. Okay, there's a lot of math on this page. I'm not going to go through every number, but here's the general concept of UDFI and what you would see referred to as UBIT, or unrelated business income tax. If a finance property generates income, unrelated debt financing income is earned. Tax could potentially be triggered. If, let's just say, 50% of the property is financed, generally speaking, the concept is 50% of the net income from that property would be taxable to the IRA. Now, you are allowed, as you can see here, deductions, depreciation, expenses, things like that. So this is This is where at the end of each year, you're actually required to file a special tax return for your IRA called a 990T. And if after these calculations it's determined that you owe tax, you will pay that out of the IRA. It's purely touching the IRA, doesn't touch your personal income. As you see from the calculation on the screen here, on a high level, this particular example was a $100,000 property that was 50% financed, receiving about $1,000 a month in gross rent. After deductions, it was determined that $1,495 was unrelated debt financed income. And it's actually good to know that the first $1,000 of this type of income is exempt from tax. So in this case, this person only had a income that was taxable of about $495 and owed about $75. So this is something that we can help you out with. We do offer services to help file these if you do decide to leverage properties inside your IRA, or if you have a competent CPA, tax accountant, obviously they can do this as well.
So one of the things that I learned about from Mike on this that is really interesting, I had heard of UDFI and UBIT tax, that if you use leverage inside your IRA and get financing, that you can be subject to, this type of tax for the percentage that's financed. But what's pretty incredible to me about this slide is you say, okay, I financed half of my $100,000 property. How much tax am I going to owe on the $50,000 of leverage that I used to finance half of my purchase? And on the bottom here, you see it's only $74, right? So that number was a lot smaller than I had kind of imagined it might be on something like this. And the other thing, Mike, I want you to talk about that you taught me was in terms of the sale of the property. Okay, how that works with the capital gain, and what happens if you, if you're a long-term buy and hold investor and you pay off the leverage before you sell, at least a year before you sell the property.
Yeah. So you see a term on this slide, everybody. It's average indebtedness, and basically that is over the course of that tax year, what percentage, as you're paying down the mortgage, obviously, what percentage of the property was leveraged. So obviously that number is going to shrink as you go along, as you pay down that debt. If let's say you're down to 5-10% indebtedness, it's very likely that you will owe little to no tax because such a small percentage of the income is potentially taxable. Now, what Matt is referring to here is, let's say you hold a property for 10 years, you paid off the mortgage in year 8, and as long as 12 months has passed after you have paid off that mortgage and got that average indebtedness down to 0, you go to sell the property, you are not subject to a UDFI tax because there is no leverage at that point.
That's amazing. So even if, let's say, you hold the property for 10 years, let's say it goes up, 5% a year, so it's worth 50% more than it was when you bought it. So you buy it for $100,000. Let's say you sell it for $150,000. You got a $50,000 capital gain. As long as you paid off the mortgage at least 12 months before you actually sold the property, Mike, they would owe no UDFI, UBIT, any tax on the capital gain that
Correct.
they made.
Correct.
Okay. So that's a really important concept, folks. When you're thinking about incurring debt inside your IRA and using leverage, what are the real consequences of that? Well, here you can see what the consequences are for the rental income in this example of $74 or so, and then if you're able to pay that mortgage off before you sell, so that you're not going to owe the capital gains. So there's some really important strategies here, okay, which is again why you need to be working with experts that really specialize in the real estate space, the rental property space, and can really advise you on how to do this with the lowest tax consequences possible.
Absolutely. So to kind of start bringing this home here, there's one very important concept using self-directed IRAs and 401ks is that of disqualified persons and prohibited transactions. Okay, there are certain people that your IRA cannot transact with, and by transact with, we look at in terms of real estate. You can't buy from these people, you can't sell to these people, rent to these people can't use the property, you can't reimburse them for expenses on these properties, so on and so forth. The consequences, if you were to engage in a prohibited transaction, which I'll talk about before we get to who these people are, is if you're audited by the IRS and they find that you engage in a prohibited transaction and went against the IRS code, your IRA becomes distributable to you in the tax year that you incurred that prohibited transaction. And if this is in a tax-deferred environment, you're paying taxes. If you're under the age of 59 and a half, you're also paying a 10% penalty for early withdrawal. In the case of a Roth IRA, you'll have that 10% penalty to worry about if you're under the age of 59 and a half. But at that point, you no longer have all of these funds in a tax-sheltered environment. So who are these people? Well, that would be yourself. So you can't buy a property, your IRA can't buy a property that you already own today. Your spouse, descendants, ascendants, so basically I like to put it this way: parents, grandparents, children, or grandchildren, as well as spouses of those people. Aside from that, you have disqualified entities. So if a business is owned or controlled 50% or greater by any combination of these people or these people's IRAs, that's a disqualified entity, and you cannot transact with that entity. Now, as we talk about, we always use the example of Stan. If any of you have attended any of our events, I'm sure you've met him. It's one of our more successful clients. He uses a couple powerful concepts here. He has 15 self-directed accounts. And this, he may have more or less today. I don't know. That this was a slide from about a year ago. But you look at your family members. If you're married, your spouse's IRA can partner with you on investments. You can't buy from them, you can't sell from them or sell to them, but you can partner with them. If you have kids that you open IRAs or educational savings accounts for, they can be in on investments with you. So Stan is one of those clients that actually will pool the family's accounts together on investments so that everyone benefits. Okay. Another concept that you see is that of a private bank, which we talked about earlier, with basically acquiring funds from friends, other investors, people who are not disqualified to your IRA. They can actually lend money from their IRAs to you or your IRA and fund your investments. Obviously, you're giving them a interest rate return on the back end, and ideally you are securing these loans with real estate. So basically you're taking on mortgages from private individuals, hence the concept of a private bank. And obviously, a lot of folks in the real estate world are big networkers. A lot of people who are interested in this stuff, so you potentially have a pretty big source of funding available to you through understanding the concept of self-directed IRAs. One quick example was actually in his case where the Roth had $4,500 at the time, borrowed the balance. A lot of people will say, hey, look, I can't do a lot with $4,500, but people who can lend funds potentially to you. Obviously, in this case, he profited pretty big, and now he had a pretty sizable balance in his IRA because he understood the concept of that private bank. So if you don't have a retirement account today, there are ways for you to contribute that small amount of money. Start contributing now and make some successful investments to really catch up on your retirement savings. So in bringing this home here, how do you get started? How does it all work? So the first step is to open and fund an account, and you notice that you need to do that before you find a piece of property that you want to buy. And I'll talk about why in a minute. But once you open the account, you find the property, you direct us to invest your IRA funds into that property, and then your IRA owns the property and you manage it. So we'll quickly walk through these here. As you talk about opening and funding account, basically there's an application. We'll help you either move funds from existing retirement accounts into this account or contribute. If you're starting to make contributions, there's a minimum contribution of $500. But the transfer or rollover process can take 2 to 3 weeks. So basically that is us requesting funds in the case of a transfer from your current IRA. That process can take about 2 to 3 weeks to have your current custodian move funds into your equity trust account. But once the funds are here and clear, you can invest day one. So conceivably, you could be buying your first real estate property inside your IRA within 21 days. What's the cost? There's a $50 setup fee for each account, and then you'll pay a flat annual maintenance fee based on your account value. One nice thing about equity trust that clients like is we do not charge transactionally. We do not take a commission percentage when you make successful investments, so it's a very predictable expense. Once you have the account open and you find the property, you will direct us to invest in that property. Okay. On our end, that's basically just a matter of sending us the purchase agreement, something called a direction of investment form, which is a form that you'll have access to with your account. And assuming everything is all in order, we'll send the funds out for closing. Matt, if you want to interject here, kind of tie this into how it works with your process there.
Yeah, exactly. So I'm just gonna share with you folks how this would work. Let's say you wanted to buy a property through Maverick, okay? And a lot of you on the webinar here tonight have bought properties through Maverick, so you know exactly how that works, right? You would go onto our website at MaverickInvestorGroup.com. You'd take a look at the properties available in our property vault after you log in, and then you would just click the reserve button, and you would submit a reservation for a property. That's how you normally buy a property through Maverick. The seller would send you the contract. You would then review the contract, of course, and then when you're comfortable with it, you would sign the contract and send it back. That's how you would normally do a real estate transaction. And then you'd send your, then you'd normally write your, $5,000 earnest money check and send it into escrow, and proceed that way, right? So if you were doing the same thing, but you were buying it in your self-directed IRA instead of by yourself or with your entity, what you would do is you, the individual person, would still submit the reservation. You would submit it, though, with your IRA on behalf of your IRA. So instead of your personal name, the buyer's name in the contract would be the IRA's name, okay? And then the seller would generate the contract with the IRA's name, and that would come to you personally, okay? And then you would review the contract as normal, and then you would sign the contract on behalf of your IRA. So all of that would be the same. The only difference is instead of you writing the check yourself out of your checkbook for $5,000 and sending it to escrow, you would simply instruct Equity Trust to write the $5,000 check out of your self-directed retirement account that you're buying it in, and send that over to escrow. Did I get that correct, Mike?
Yes.
Okay. So it's basically the same process. You can immediately, let's say you're on one of our buying opportunity webinars, and you like what you see, and you go to the vault and you say, oh man, I want this property. You can reserve it immediately that very minute. Just as you normally would. You just type in your, the name of your IRA instead of yourself. Boom, you got your reservation in. Contract comes out from the seller. You can sign on behalf of your IRA and send it back. All that is identical. It's exactly the same. There's no delay or time lag or anything like that. The only difference is getting the earnest money, and then of course the funds at closing over to the title company. You would just instruct Mike over at Equity Trust to do that on your behalf, and then they would send that over. And that takes what, Mike, like 3 days or so?
Yeah, standard processing is 3 business days.
Okay, but the point is that it doesn't delay your ability to reserve or to buy or to sign a contract or any of that kind of stuff in terms of how the Maverick process works.
Yeah. And Matt, that I guess that ties into the next part here, where at Equity Trust, what's going to happen is, once you reserve that property and you start to go through that process, and you send us that purchase agreement and that direction of investment form, an investment liaison at Equity Trust will now become your single point of contact for purchasing that property using your IRA, and that person will work with you until closing and beyond. For that property. So you'll have a single point of contact, you'll have their contact information, and work with them. Now, moving forward, there are expenses that potentially come up that you need to have come from the IRA, such as, let's say you're paying property taxes, you have a bill that needs to be paid, whatever the case may be. We have a very fantastic bill pay system that you just log into your account and you use online bill pay, and we'll send the check out for whatever that expense may be. The point is, with this, creating an audit trail. By you logging in and sending us a direction of investment to pay the utility bill, now if the IRS were to audit you, in your IRA, there's record of that transaction and what it was for specifically. And Matt, I think this is a good time to address the concept of the checkbook. Would you agree?
Yeah, sure. Go ahead and address that. It was one of the things I asked you to speak on. There's, for folks that have looked into this or been in the space for a bit, there's something called, that people talk about called checkbook control of their IRA. And I wanted Mike to speak about this a little bit and share that concept and where Equity Trust is on that concept.
Yeah. So basically, if you do research on the internet on self-directed IRAs, you're going to find this term checkbook control, or you're going to speak to a company who tells you this is the way it has to be. Basically, what the concept is this. A single member LLC is created. The IRA is the single member of that LLC, and then the IRA will then invest. You will direct your custodian to invest your IRA funds into that LLC, which means that your IRA funds are now sitting in a business checking account under that LLC's name, which sounds great, right? You can write checks right out of the account. You can use your debit card, so on and so forth. But the challenge is it's very easy to screw up. All of the liability is now passed on to you, the IRA owner, to understand the IRS rules and regulations involving each transaction, right? And as we mentioned before, the consequence of a prohibited transaction, whether you know you did it or not, you may have the best intentions in the world, but the consequence of a prohibited transaction is you losing your IRA status and having that account fully distributed to you. Okay, so it's a greater risk. There's nothing illegal about checkbook IRAs. It actually is, it's not specifically prohibited. It does come with a higher cost generally because you have a lot more costs associated with upkeep of a business, and generally speaking, someone's going to charge you $1,000 to $3,000 to set it up. Another challenge is agility. Once that entity is formed, it becomes an existing entity and is subject to those disqualified persons rules, where if an entity is 50% or greater owned by a disqualified person, you cannot transact with, your IRA cannot transact with that entity. At that point, you no longer can put IRA funds into that LLC. If you need to do that in the case of an emergency, you would, in a lot of cases, need to create a new LLC. Which obviously could be a challenge on its own. But really, what it boils down to, and Equity Trust stands on this, the IRS sees this as it's very easy to abuse, and people have abused it before, so the IRS is actively trying to target and seek these out so that they can keep a closer eye on them. So you're at a higher risk for audit, and at Equity Trust, because we've been doing this a while, we do not offer that checkbook LLC setup. We don't want to put your retirement funds at risk. Ideally, you don't want to put your retirement funds at risk. And from everything that Matt's telling me here, especially with their process, having to wait 3 business days for a transaction, worst case scenario, shouldn't be that big of a deal. But obviously, you have both options available to you. Just wanted to make sure we address that on the webinars. I know the question always comes up.
All right. Cool. So with the Maverick process and the reserving in the Maverick vault and that kind of stuff, it's not anything that's going to slow you down, as long as they're going to be able to get your earnest money to escrow in 3 days, and in the meantime you can reserve the property and review the contract and get that sent back and all that. So that's not anything that'll slow you down if you're buying property through Maverick. So okay, do you want to mention about what the account online access here, and if they decide to open an account with you, how this all works?
Yep. Yeah. So it's pretty much the final part here before we close out. So you will have online access to your account. You have access to a ton of educational material. We have an online community where you can network with other clients, as well as pay bills, see transactions on your account. As you see here, that very good button right in the middle is generate a proof of funds letter. If you're ever in a position where you need to have that generated, you have that at your fingertips.
Awesome. Cool. All right, Mike, now we're not going to close out yet because we have the most important part here. We have the two most important parts of the evening are right here, in fact, which is one, what you're going to offer to our clients, and number two is the Q&A, so folks can get their questions answered by you, which is, I know, why a lot of people tuned in tonight. So why don't you go ahead and tell them what you have for a special offer this evening.
Well, very good. So in working with Maverick here, as part of this webinar, as part of you attending and watching this here, we have a bunch of gifts and materials that we're going to offer to you. So first is our IRA Success Kit for real estate. There's 3 reports that you're going to get in this. I won't read the slide to you, but this is, as you can tell, there's a lot of information that we covered tonight. There's still plenty more information that you could potentially need to learn. You should want to learn if you're going to do this. And so we're going to make these 3 reports available to you to cover your bases with that.
Guys, all of these bonuses that we're talking about here are at no cost to you, and there's no obligation to you. So we're going to show you how to go and get all of this free content. I would highly encourage you to do that because it's going to allow you to go through it. Number one, it'll be a lot more information. Number two, it'll allow you to go through it at your own speed, depending on how much knowledge you have about this stuff, and allow you to learn more about this, okay? So 3 special reports here: real estate investing with your self-directed IRA rules and regulations, and the guide to self-directed retirement investing. Okay, this is your first set of gifts that are available to you tonight. Mike, what's the second set?
The next, in addition to those PDFs, will actually be some audio downloads. So self-directed investing from A to Z. Our CEO actually will be on one of those, talking about those rules and regulations that's important that you understand as you're engaging in this, how to cultivate multiple streams of income, how to create that private bank, right? Talking about borrowing other people's money and understanding that, as well as case studies of some of our successful clients. And so we actually give you real examples of how folks have done this and been successful with it.
And that's really important, folks. These are a lot of the case studies are, how people initially got started. Okay, they went from opening their account to becoming very successful self-directed investors, and how they got started, how they did that. Okay, so you're going to get a bunch of those case studies as well. Mike, bonus number 3.
Snapshot of self-directed investing. This is another audio download. You have 5 principles of real estate wealth, which actually is from Greg Rand. You have how to create tax-free wealth as an individual or a business owner, which again is from our CEO. And then finding out which account makes the most sense for you. So you'll get a good background of that. Obviously, it's still good to speak with, as Matt said, speak with us here at Equity Trust, speak to a professional to understand what makes the most sense. But this will give you some additional information to help you make that determination as well.
Okay, so in just a minute, folks, I'm going to give you the link on where you can get all of this content for free at no charge. You're just going to go to the link and you're going to get it. They're offering it to all of the Maverick clients here at no cost to you. But we're not done with the bonuses, Mike. Tell them what else you're going to offer to them.
All right. So as you know, I've built a relationship with Matt here, and want to make sure I provide some additional assistance to Maverick clients. I'll actually offer a personalized phone consultation with anyone who wants it. When I speak with you, I will cover your personal situation. Obviously, everyone's situation is different. We'll talk about your current financial or retirement situation, understand what your goals are, and then obviously help make you with the account or accounts that make the most sense for you. And there's no obligation, right? This is purely informational. If you want to open an account, great. If not, great. We're not going anywhere. So whenever you're ready, we'll be here to help you. But this will help you at least start making some plans if you're not ready to do something just yet.
And guys, just so you know, I asked Mike for this personally because he manages my personal account at Equity Trust. And so what I asked him for, I said, listen, when the Maverick clients come in, I'd really like for you personally, because we're not going to be able to answer everybody's question on the webinar tonight. There's a lot of people on here, and I really think it's important for everybody to be able to really go deep into your own personal situation and understand that. And Mike said that he would do a phone consultation with every single one of the Maverick clients that wanted to do that with him. He would do that for you guys. So you're going to get Mike personally. It's not going to be, some, I don't know, I don't know what regular kind of intake, person or whatever, but you're going to be able to do that with Mike personally if you choose. He's offering you that, okay? And then finally, Mike, number 5
is if this is something you are ready to do, and you decide to open an Equity Trust account by the end of March, we'll actually waive your $50 setup fee. The reason March 31st is there is there's a number of reasons, but one thing that's important to note right now, if you've not filed your taxes yet and you've not made your IRA contributions for 2014, you could still make those. As well as make 2015 contributions. So we wanted to do something to incentivize you to possibly get an IRA open before tax time if you've not started saving for retirement or you've not made your contributions yet.
All right. So with that, in order to get access to all 5 of those bonuses, you don't have to start an account with Equity Trust. I know there's some people on here that already have accounts with Equity Trust. So in that case, you can take all of the free educational content and and take the free consult with Mike if you want. Just chat about your personal situation and go deeper on this stuff. I certainly did, and I sure learned a lot. As I've been talking with Mike and working on my own account over the years here. So this is how you get all of that stuff. I had a question come in and it says, do we all get all the bonus items? I'm not a current Maverick client. Everybody that's on this webinar tonight is considered a Maverick client. Okay, you're here. It doesn't matter if you've bought real estate through Maverick or not. You're here tonight. Either you were invited directly by us or you were invited by an agent in our network. That means you're coming through Maverick, and that means you get all of the bonuses. So just go to maverickinvestorgroup.com/self-direct, and that is going to take you to the landing page where you just enter your information and submit it there. You're going to get immediate access to all of those reports, all of those audio downloads, and everything else, and you're going to get an opportunity, if you want, to schedule a personal phone consult. Everybody that fills out that phone consult form, that goes directly to Mike. Okay, so he will reach out to you personally to schedule the call with you to talk through your IRA, 401k, other self-directed retirement plans, understand your goals, your needs, answer your questions about your personal situation. And then, of course, if you do decide, if you're not already an Equity Trust client or you want to open up another account with Equity Trust or you want to convert or your funds from somewhere else or whatever it may be, if you want to open up something new this quarter before March 31st, they're going to waive that setup fee because you're coming through Maverick, okay? So with that, what I want to do right now is I want to open up the floor for questions. We've got Mike here with us live tonight, so feel free to enter your questions in the chat box, and I will take as many of them as I can here, and we'll start going off from there. So we already answered the question about checkbook control and why Equity Trust intentionally does not offer that or advise its clients to use that technique. We also talked about why that does not impede you from reserving properties through the Maverick process. Does not slow you down at all for that. We did get a question here about, can we buy properties outside of the Maverick vault? Well, of course you can. You can buy anything you want. You can buy whatever type of real estate you want, wherever you want, as long as it's not a prohibited transaction. You saw that giant list of other stuff you want to buy. You want to buy precious metals, or you want to buy an oil and gas company, or whatever it may be. As long as it's not a prohibited transaction, of course you can buy anything that you want. So let me start here and start putting some questions out to you, Mike. First one is, does Equity Trust file or account for IRS tax consequences of real estate holdings within the self-directed IRA?
Good question. So I may potentially need some clarification on that, but we do all of the IRS reporting that is required in terms of how much you contribute to the account, how much you distribute from the account, the value of your account, what's in your account, general information like that. If you are referencing the potential to owe UBIT or UDFI tax, that is an obligation that you have to file that tax return. So if that's the reference there, which I believe it is after reading the question, that hopefully should address that.
Okay, great. Next question is, can you...
Matt,
yeah.
Matt, real quick, we do notify you if we notice in your account that you may have incurred that to look into that. So just let you know that.
Okay, great. And folks, if anybody needs also, I mean, just so you understand, if anybody needs a referral to a CPA, for example, who specializes in investment real estate, Maverick is also happy to, open up our, golden Rolodex and make, a referral to a CPA or two, for example. I mean, we can introduce you to a couple top people in the industry, and you can interview them and see who feels like the best fit for you. But we are here to support you in your real estate investing. If you need access to certain types of professionals or looking for recommendations or that kind of thing, we're happy to make those introductions. So, you can get in touch with us about that if you need anything else as well. Okay. Let me take the next question here. Can you buy property with a combination of Roth and traditional IRAs?
Yes, you can. You can partner your IRAs together on investments, again, keeping that undivided interest scenario. Also, if you're talking about the 401k, where you have tax deferred and tax after tax buckets, you can also pool those together on any investment. So basically, whatever percentage your traditional IRA would own would need to stay consistent throughout the investment, and whatever percentage your Roth would own would need to stay consistent throughout the investment.
Okay. Next question. If you purchase a property and sell it with a profit that goes back into the IRA, will that money be taxed?
No. So again, IRAs are not subject to capital gains or ordinary income tax. There is a potential to incur a tax if you do a lot of property flipping over a short period of time. If you're holding properties for more than 12 months, you're not going to trigger any sort of capital gains tax or anything like that.
All right. That, of course, is the point of doing it. Is one of the advantages of doing it in these vehicles. The next question says the annual fee does not cover the LLC fee, right? And Mike, maybe this is
Yeah, it's a good time to reiterate that the LLC structure is not offered by Equity Trust. So that is definitely something that the fee does not cover.
No, it doesn't. It does not cover an LLC. But can you speak about the asset protection components of the self-directed plans? A lot of people that buy real estate are familiar with the concept of an LLC as asset protection, right? They want to own the property in a separate legal entity and so forth. But can you talk about the asset protection components of the self-directed plan as an alternative to an LLC, and and how some people are even segregating their assets and that sort of thing?
Yeah, absolutely. So the IRA is a separate legal entity itself from you. So it's also important to note that because it is a legal entity, the IRA can hold property directly, which means you do not have to set up an LLC in order to own the property. Furthermore, from an asset protection standpoint, because an IRA will provide similar protection to what an LLC will, what you look at in terms of real estate is the liability, the potential liability created with owning the property. So let's say you have an LLC set up that owns 2 rental properties. and somebody slips and falls on rental property A, and they sue the owner, which in this case is the LLC. Both of those properties, if they're held by the LLC, are potentially at risk. Okay. Same concept is with the IRA. If your IRA owns two properties inside that single IRA, then the same scenario happens. The assets that are owned by that entity are potentially at risk. So what a lot of people will do, we actually had a client's attorney advise him to do this for his situation, is if you are going to own multiple properties, from an asset protection standpoint, they will actually set up multiple IRAs. And rather than using their name in the titling of the IRA, they'll use their account number so that each IRA actually has its own unique identity. And then if you have one property per IRA, something were to happen, generally speaking, you're looking at not risking the other assets that are owned by separate entities. Obviously, I'm not a lawyer, so I can't speak specifically, but that's where I say, the LLC doesn't necessarily provide any additional asset protection unless you have other holdings inside that IRA.
Okay. But what I think was important, though, that you mentioned that some of your clients are doing is they're just creating separate IRAs for each property that they buy. So
correct.
If they own 10 properties, they can have 10 separate IRAs, and then you've segregated your assets and segregated your your liability in a similar fashion. Next question. I am a realtor and a real estate investor. I purchase homes at auction or through the MLS. If I purchase these homes through my self-directed retirement plan, is the real estate commission the commission that he would earn as an agent able to be earned separately off of that, given that the seller pays the commission?
No. So you cannot personally benefit from your IRA's investment. There's actually a specific case which I don't have in front of me. Long story short, you cannot receive, if you're a realtor, you cannot receive a commission from a property that your IRA is buying or selling. Okay,
that is important because we have a lot of real estate agent clients. So that's an important piece. Okay, next question. Is it correct that solo 401k is exempt from UBIT?
It is exempt in the scenario where you're leveraging a property, you're using debt financing, and you're generating rental income. It's not a blanket UBIT exemption, but for that specific scenario, it is exempt.
Okay, so on that slide that you saw earlier, where Mike went through the UBIT tax that would be due on the $100,000 property, where you finance 50% of it, and you'd owe like $75 or whatever it was, then you would be entirely exempt from the UBIT. It wouldn't just be a $1,000 UBIT exemption. It would be the total exemption on that rental income, right, Mike?
Correct. Yeah. In a scenario where you would incur it still with the 401k potentially is you acquire a property with financing and you flip it within 2 or 3 months. Let's say in that case you have generated some income that is taxable.
Okay, now remember though, folks, we went through the scenarios where if you want to eliminate the UBIT tax on your capital gain from your sale, then all you have to do is pay off your debt, your financing, right, that you use to leverage the property at least 12 months before you sell, and that's how you get rid of the UBIT on your capital gains. Is that correct, Mike?
Correct.
Okay, so again, there's ways to do all of this stuff. You just need to plan properly. Okay, that's why consulting with experts, developing your personal plan for your personal situation is important. And I would encourage you, when you do the consult with Mike, I'd certainly encourage you to at least have the consult. When you do it, start your question with, how can I achieve this? Okay, and then Mike's able to say, well, do you have this? Can you do this? Can you do that? If it's no, 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 well, then we could maybe do this other thing and so forth. So start questions with how can I, and that stimulates a lot of creative discussions where you can then figure out based on your situation what you need to do, which might be different than what somebody else needs to do. Okay, next question. I was told there can be no commingling of funds, so if I purchase through an IRA, all expenses need to be paid through the IRA, correct?
Correct. Commingling just basically means if your IRA financed the purchase 100%, you can't use your own personal funds to pay a contractor or to buy some paint at Home Depot.
Okay. Does the monthly cash flow from a rental property go back into the IRA?
Yes. If the IRA owns the property, it receives the benefit, which in this case is the rental income.
Right, guys, and that's why this is so beneficial, okay? Because normally you would, if the rental income came to you and then, you sell for a gain and all this kind of stuff, you got to pay tax on all that stuff. If you do it inside the retirement plan, that's the whole point. The rental income comes to the retirement plan. The benefits of owning the property, including any appreciation that it accrues, if you sell later for a gain, all that kind of stuff, all comes into the retirement plan without you having to pay tax on it, right? Except these situations if you use leverage and you do these extenuating circumstances. But if you're buying properties for cash and stuff, I mean that's the whole ball game is being able to do this and allow all these benefits to flow into your retirement plan without you having to pay tax on them, because that then compounds and grows your wealth with just exceptionally increased velocity. Okay. Okay, I followed the link that you have on the screen. I don't see where to schedule an appointment with Mike. Where do I do that? Okay, so if you go to the link on the screen, it's going to have an opt-in box there, and it's going to tell you that you get all of your educational content there. So submit your information there, and as soon as you submit that, on the next page is going to be your educational content. You get it all immediately, and that's also where the offer is going to be for the personal phone consultation with Mike. And you can just submit your information there that you want the phone consult, and that'll come directly into Mike, and he'll be reaching out to you to schedule that over the next week. Okay. Can the bill pay feature be used for an earnest money payment? How long does it take to issue the check for an earnest money deposit?
Good question. So the bill pay feature, I use the term loosely. As it is today, it is different than initiating a new investment. It's just as easy to initiate a new investment where you just email your docs to us, or you could fax the docs to us to request that earnest money, and it works just as quick as the online bill pay system. Standard processing is 3 business days. There are scenarios where it can be expedited, which I don't want to get into detail with now, but there are scenarios where it can be expedited, but generally speaking, it's 3 business days. Okay,
great. This is a question. Is the IRS publication of self-directed IRAs in Section 590A or 590B?
Both. In 2014, the IRS split up 590 into A and B, which covers distributions. One of them covers distributions, one covers contributions. IRS publication 590 as a whole governs all IRAs, not just self-directed IRAs.
All right. Next question looks like maybe a comment. So it sounds like it's better to run a rental property as hands-off, i.e. using a property management company to address all the expenses and then to reimburse the management company. That's certainly the concept that Maverick Investor Group encourages normally, because why on earth would you want to be a landlord? Whether or not you're buying in an IRA, it definitely makes a lot of sense for people to value their time, which should be your most valuable asset, not to be dealing with tenants and toilets and trash yourself, but to hire a professional property management company that, number one, does that professionally and can give your tenants extremely high quality service, and number two, whatever you have to pay that property management company as part of your monthly income, hopefully your time is worth a lot more than that. So that certainly makes a lot of sense. Our clients are absolutely building portfolios of properties, and by not being a landlord, that also allows you to buy in other real estate markets that are likely better than the one that you live in, or even if you live in a great one, to diversify across markets and to buy in different parts of the property cycle and that kind of stuff. So that's certainly something that that we encourage folks to do for those reasons.
And Matt, I would also say too, in a lot of our clients' cases, that actually simplifies the process. when it comes to paying for expenses and rent checks is in a lot of cases that property management companies collecting the rent. They may cover incidental expenses day to day and be reimbursed from the IRA. Obviously, everyone does it differently, but that could potentially simplify things and make it to where you're looking at the bill pay feature. The 3 days may be a moot point at that juncture.
Exactly, yeah. The property management companies usually aggregate all of that stuff. So they take out their own fee, they take out their own expenses, that were used for maintenance, and they just send you the remainder of the rent. So that absolutely makes your life a heck of a lot easier, both inside the self-directed IRA plan and outside of it. Okay, Warren, your question, you're saying that on the page it says that, on the consult page it says that request a call with a qualified equity trust specialist. Does this mean Mike? I don't see his name mentioned there. Yeah, that means Mike. For us, that is Mike. So the page that you're on is actually a special page that Mike and his team created just for folks coming through this Maverick webinar. Okay, and so all of you who register on that page for the phone consult, all of you are going to get that phone consult with Mike. Okay, that's going to come into him. He's going to contact you, and you're going to be able to schedule that with him. So where it says equity trust specialist, that in your case, because you're a Maverick client, that means Mike personally. Okay. So, okay, Mike, is it the case that the self-directed IRA mandates you not to directly manage the property? I guess it means like as an individual.
Sure. You actually can manage the property, but you also have to. Everyone defines manage differently. I like to tell people you can direct things to be done to that property. Just make sure you are not personally, physically doing any work, nor is anyone who's a disqualified person doing any physical work on that property. It's considered sweat equity, and long story short, you can't do it. The easiest thing to do is make this as passive of an investment as possible.
Right, which you would hopefully want to do anyways. Next question, Mike. Next question. Can a partnership be established between yourself and your solo 401k for a real estate purchase?
Good question. So your retirement account in general can partner with anybody. From a logistical standpoint, it is actually a little bit more of a challenge to partner with a solo 401k and yourself. But that's going to be specific to a scenario. Generally speaking, though, yes, you can partner your own personal self. Let's say you own a property 30% and your IRA owns it 70%. Yes, you can do that. When it comes to the 401k, it becomes more of a challenge because of certain laws and certain regulations and logistical issues. But if the person that asks that does request a consult, I'll be happy to walk through their scenario and see what makes sense there.
All right, fantastic. All right, guys, I want to leave it there. Okay, we've been on now for almost 90 minutes, and I know you guys have gotten a lot of content out of this. Hopefully, you've gotten a lot of value. We want to bring you value. As Maverick Investor Group, bring you things, information, introduce you to specialists and people who can help add value to your real estate investing. Okay, so hopefully you got some value out of this webinar. I would encourage all of you to go to this link and at least opt in for the free content. I mean, at least get the reports and the audio downloads, and educate yourselves further about some of this stuff. Obviously, the free consult with Mike is, in my opinion, something of very high value. Certainly, my personal discussions with him have educated me quite a bit on some of these finer points, and I would encourage you to talk about your personal situation with him, see what the best direction is that you want to go for you, and then if you do decide to open an account with Equity Trust or another account with them or convert your funds over to them, they're going to waive the fee for you if you do it this quarter before March 31st. And so if you do have any more questions, anything that didn't get answered, you can schedule the consult directly with Mike and ask them all to him personally. So bring your questions to that consult, and man, take advantage of that time you have with an expert to get all those answered and talk about your personal situation. Mike, I want to thank you so much for being here and spending time with our clients. That has been really great, really informative, and we appreciate you taking the time out of your evening.
No, thanks for having me, and I look forward to continued dialogue with anyone who's interested on the call.
All right, guys, maverickinvestorgroup.com/self-direct. You can go there now, and you can grab your bonuses. Thanks, everybody. Great to have you here, and have a wonderful evening.